Hello, this is Will Allen with Centera Capital. Today we're going to give you an update on the most important factor driving the financial markets over these last few months, and that is interest rates. But that's not all. We're also going to check in on the state of the U.S. consumer. Let's dive in. In our last market update on October 7th, we started to take a look at something that had occurred on July 31st that, quite frankly, over those last couple of years has not been a big deal to the markets, but has all of a sudden become one. And so we talked about the fact that on July 31st, the Treasury Department put out an announcement that said for the third quarter, they were going to be issuing over $1 trillion of Treasury bills and Treasury bonds. This was basically to fund the spending of the government. And this really took the markets by surprise because the markets were expecting numbers in the $700 to $720 billion range. And so when the Treasury Department said, hey, it's going to be over $1 trillion, that became an issue for the markets. Let's put up this chart and explain why that is. So if you take a look, this shows you the balance sheet, change in the balance sheet of the Federal Reserve that started when COVID happened. And the Fed decided, okay, we've got to step in. We have got to print money. We've got to back up the financial system. So they started buying a lot of federal debt. Well, about a year ago, they came to the conclusion, hey, inflation is a lot higher than it was expected to be. In fact, we no longer are going to be buying these Treasury bonds, but we're going to be selling some of our own. And so what you'll notice when you look at this chart is for the first couple of years post-COVID, as the federal government spent money, the Federal Reserve was soaking up a lot of that and buying a lot of those bonds on their balance sheet. But notice there has been a huge gap that has emerged over these last 6 to 12 months. Now you're in a situation where you've had over $10 trillion added to the federal deficit. At the same time, the Fed has only soaked up about $3.5 trillion of this. The remaining $6.5 trillion has to be soaked up in other ways. It used to be, going back 3 years, 5 years, 7 years ago, a big buyer of our bonds were the Chinese and the Japanese. Well, they have not been buying as much in the last year, a year and a half, for different reasons. For example, in China, their economy is just not growing very fast. They determined, look, we got to, instead of buying U.S. treasuries, we're going to bring that money back home and spend that here to try to stimulate the economy, okay? So what has happened is a lot of this $6.5 trillion has had to be soaked up by U.S. investors, endowments, and pension funds. So on July 31st, when the Treasury Department said, hey, we're going to be issuing over $1 trillion in the third quarter, what has happened to interest rates since then is the Treasury's had to, basically when they are issuing these bonds, they have had to increase the interest rate in order to get buyers to come to the table. And so you can see that the interest rate on a 10-year Treasury has gone from 3.97% on July 31st to 4.88% now. That is a big increase in interest rates in just a short period of time. Now, the reason that it's expected that they can leave rates where they are on short-term interest rates is that the 10-year Treasury rate has gone up so much in the last 2 months, like we talked about, and that has tightened financial conditions. The best example of that for people to understand is look at what has happened to mortgage rates over the last 2 months. A 30-year fixed mortgage was at 6.9% 2 months ago. It's over 8% today. And so that's done some of the work of the Fed. And so hopefully the Fed tomorrow makes the decision to say, hey, we're not increasing interest rates. We do believe that the rise in the 10-year Treasury has done our job for us. Okay, so that's what you need to know about interest rates. Now, let's talk about and switch over here for a second and talk about the state of the U.S. consumer, because we got some good news on this front. Over the last month, we got a U.S. GDP report that said in the third quarter, the economy grew at 4.9%. That is an incredible growth rate. Now, it's not going to sustain at that high. In fact, for the fourth quarter, expectations are now between 2.5% and 3%. But it's really remarkable given that we're almost 2 years into a Fed rate hiking cycle, and this economy still put up a 4.9% number. And the major reason we saw a 4.9% growth rate, the U.S. consumer spending was really, really strong. One more thing. We heard from Visa, MasterCard, and American Express. They had their earnings reports, each of them, in the last week and a half. All three said that the U.S. consumer and spending is still looking really, really strong. And that's very, very important because the U.S. consumer is what has separated our economy from those in Europe and Asia and other countries that are not having the growth rates we are and have not had the financial markets have done much poorer in that same time frame. So companies can have better revenue growth and profit growth if the U.S. consumer is spending. Right now, they're still doing well. The jobs picture is still very, very strong, meaning the economy is adding 250, 300,000 jobs a month, and there are still almost 10 million job openings out there still to this minute. So anyone who wants a job right now can still get one, and that is powering also consumer spending. That's all we have for you today. If you haven't gotten a chance to check out our updated website, CenteraCapital.com, you can go to Market News and like and subscribe. Send this to any of your friends who may not be getting this kind of updates from their advisor, and we appreciate that. Take care.